So are we in a recession? Let's get straight to it. So there are usually 8 signs that we are in a recession. So the first sign would be an inverted yield curve. Inverted yield curve is when the 2-year bond is paying more yield than the 10-year bond. This happens because people panic and move to a safe play like a 10-year bond. The price of a 10-year bond gets more expensive as more people buy it, which causes the yield to drop. The Fed raises rates to kill inflation. That rate is closely correlated to the 2-year bond. If the 2-year bond is paying 5%, but the 10-year pays 4%, it creates an inversion of -1, and that will get people confused because why would you buy a 10-year bond and get paid 4% when you can get a 2-year bond and get paid 5%? It doesn't make sense, and that will usually lead into a recession. And then it's happened a few times where we've gone into recessions. So back in 1989, I believe, we did hit an inverted yield curve of zero point 0.6, so minus zero point 0.6. That was 1989, and then we went into a recession in 1990 to 1991, right here. So first we get the inverted yield curve, and then we go into recession. So it happened again over here. It happened on June 2000, the inverted yield curve of 0.59, of minus 0.59, and then we went into recession in 01, 02. And then once again, the inverted yield curve again, it hit again, minus 0.23, and then we went into the recession of 07, 09. This was a black swan event. This was COVID. It was not supposed to happen, but it didn't burn. But the Feds, they had to cut rates to save the economy. And then, as most recently, we did hit an inverted yield curve again. I believe so. We hit about July 2023, and this signals a recession as well. And so that's our first sign, inverted yield curve, that can lead us to be in a recession. And sign number two will be the GDP is shrinking. Let's look at our GDP. So our GDP has gone up. Let me zoom into the 5-year. So I mean, we are, so Q3 2025, so our GDP has gone up steadily, and this is impressive with tariffs and bad news with the Ukraine war. Our GDP is still growing, so that's great news. Our next sign that might mean that we're in a recession will be the unemployment rate is rising. So let's check out our unemployment rate. So our unemployment rate, so our lowest was at 3.4 April 2023, and as you can see, it has been going up, and more than likely this. So our unemployment rate has gone up because the Feds began raising rates, and the Feds raise rates, companies are less likely to go get a loan at a high interest rate like 8%, because it's hard to be 8% return on investment. And these companies, they live off loans to hire employees and to invest back into the company. And the rates are high. Companies are not producing more products, and more likely they are not hiring more people, or they could be doing layoffs, and this would cause our unemployment rate to go up. So far the inverted yield curve has already inverted, so that's a yes. GDP is not shrinking, that's a no. Unemployment rate is rising, that's a yes. Next, corporate profits are falling. Let's see our corporate profits. So here we go. Our corporate profits after tax. So since 2022, we've been going up. We've been going up, and then we did drop in the beginning of 2025. This is when Trump came in, and I'm guessing companies they probably panicked because of the tariff talk, and their profits probably came down, but now they have gone steady and have gone up. So overall, corporate profits after tax, they're increasing. So number four, that would be a no. Number five will be consumer spending is slowing. Now this is extremely important. Consumer spending is 70% of the US GDP. For example, for example, consumer spending could be buying Nikes, going to Starbucks, going to Disney, spending at the store. So consumer spending, let's check out consumer spending. So here we go from trading economics. Consumer spending has gone way up since 2023. We've gone way up, and as of Q3 of 2025, which would be from October till December of 2025, consumer spending hit $16.6 billion. And I wonder if this spending, well, I am pretty sure that this spending probably comes from credit cards. People are spending with credit cards. They are using buy now, pay later, paying for with PayPal, and all these other services nowadays. So this is good news, but it can be alarming if it was if it's spending using credit cards, but consumer spending is going up. So so this is a big one, and this one is no. Consumer spending is not slowing down. Next, number six, retail sales are dropping. So from April 2023, our retail sales have gone up and up and up. They did come down for May 2025, but have gone back up. So this is great news right here. So retail sales are dropping. That's a no. So next on the list is credit card delinquencies are rising. Let's check that one out. So here we go. Delinquency rate on credit cards, on credit card loans. So here we go. Delinquency rate on credit card loans. Now this again is extremely alarming. Our delinquency rate on credit cards have gone up, and it did peak Q2 of 2024, and it has to flatten out and come down. But overall, this is bad news. So this one's a yes. And last but not least, housing market is weakening. Let's see our home sales. So here we go. Let's do 10-year. So 20. So let's do 5-year. So yes, home sales are way down. 6.4 million homes sold, and it's gone way down. And this has gone down because of high interest rates. People are not buying homes because their mortgage will be too expensive. So, and as of January 2026, only 3.9 million homes have sold. So that's a yes on weakening housing market. So as you can see, we are not in a recession. The inverted yield curve is a yes. GDP is not shrinking. The unemployment rate is rising. Corporate profits are not falling. Consumer spending is slowing. Consumer spending is not slowing. Retail sales are not dropping. Credit card delinquencies are rising. That's a yes. And housing market is weakening, which is a yes. Anyway, the only way to know that we're in a recession is to have all these say yes. And as you can see, we have mixed signals. Anyways, that's what I have for you guys today. I'll catch you on the next one.